Hello, and welcome to the Asset Allocator podcast, which you can now watch and listen to. I'm Amina Zafar, funds reporter at AA. Joining me today is our very own contributing editor, David Thorpe. Hello, David.
Hello, Amina.
Also in the studio is Jason Da Silva, director at Arbuthnot Latham. Hello, Jason.
Good morning.
Thank you for joining us today. In this week's episode, we'll explore the mixed signals that bonds and equities are sending on inflation. We'll also discuss credit markets and the new wave of IPOs. So where should investors be looking next? Let's get into it. So Jason, bonds and equities don't seem to agree on where inflation is heading. What do you make of that? And how does that impact your investment decisions?
Yeah, it's one of the top questions on our mind at the moment. So I think broadly, and maybe just chatting about inflation first, kind of when we came into the year, we actually felt inflation would be higher than consensus. Now that was no kind of crystal ball that the Iran-US conflict was going to happen, but we just thought that global growth was going to be a lot more stronger than a lot of people expected, and all else equals, stronger growth, inflation tends to be higher as well. Now, of course, you've had the Iran-US conflict. That's led to higher oil price, and you've seen in the latest inflation data that inflation is a lot more sticky. But I also wouldn't underplay the importance of global growth as well, and this is particularly typified in the jobs roll number that you got on Friday. Strong jobs report, and you can see the market, especially the bond market, think inflation is going to be a little bit higher for a little bit longer. So, I think inflation is going to remain sticky. And I think if you zoom out, like over the last 5 years, right, inflation has been above target. I mean, there's no, big developed market where you've seen inflation sustainably below target. And I think this is just going to be another year where that's the case. Now, where you've seen inflation impact assets the most is the bond market. Equities, been a little bit more nuanced, but bonds has been the strongest single yet. And you've seen, of course, during the Iran-US conflict, bond yields go higher as bonds have, said that central banks are more likely to hike going forward. You've seen a number of central banks increase rates. You saw likely to see the ECB in June. You've seen Australia come through as well. Following the jobs reports on Friday, high likelihood that the US can't cut, more likely hikes in the coming year. And so that's the strongest single. Coming into this year, we were underweight bonds, just given that inflation view. Actually, during the course of the Iran-US conflict, we've sold bonds again, so extended the underweight, just thinking inflation is going to be higher. For equities, like I said, it's a lot more nuanced. So equity, there's just a lot of number of drivers in terms of how equities perform. Given the strong growth backdrop, we think that's a more fundamental driver of equity markets at the moment. And so we don't think inflation is as strong, when equity markets aren't taking as strong a view on inflation. And actually, if you look over history, as long as inflation is not, well above mid-single digits, double digits, equity markets can handle above target inflation. So that's where we broadly are. So massive, relatively large underweight to bonds, and then just looking at other diversifiers as well in our portfolio. So things like materials, which do quite well when commodities are extended. Commodities tend to do quite well when inflation is extended as well. So that's one avenue that we've used to incorporate this high inflation view, and then just a healthy weighting to alternatives such as hedge funds as well, to incorporate that inflation.
Jason, you mentioned coming into the year that you Arbuthnot Latham had a view that inflation would maybe be a bit higher than consensus. You touched on the Iran conflict, which injects supply side inflation into the economy, into the world, and that has one type of impact on asset prices, particularly on bonds. But you also referenced economic growth levels and the very healthy jobs market in the US, and that injects demand side inflation into the world or into the economy, and markets tend to view that differently. From your when you're thinking about inflation and asset allocation, is it still very much thinking about the supply side, or is the demand side impulse also in your thoughts? And maybe will the balance between the supply and the demand side inflation change over time?
Think about 2022. I think it's a good case in point where maybe you have both sides which impact markets in a very vigorous manner. So in 2022, you had the supply side, which was extremely, extremely tight, not only from a strong labor market, but also from the Russia-Ukraine conflict, which obviously tightened energy markets as well. So you had a significant tightening of supply. But then actually what happened on the demand side, while demand was maybe a bit healthier than what we've seen in kind of previous recessions, demand did actually tail off. So if you look at the first 2 quarters of US GDP growth in 2022, they were actually negative. And I know if you remember the time, Joe Biden was in and he was saying it wasn't classified as a technical recession, but your growth did come down. So in that environment, you had a very tight supply market, a supply in the economy, but demand had actually fallen off quite a bit. And so if you look at the equity market in that circumstance, it actually fell because demand fell, but supply was still too tight. And you actually saw it in the earnings growth of a lot of companies across the globe. So you actually saw like US tech companies, actually margins came down quite significantly. Earnings growth just wasn't great in 2022. So that's a case where even though supply was quite tight, demand and it wasn't enough to offset the demand fall that you had in 2022. If you fast forward to today, while supply is tight, it's not as tight as what was in 2022. The best kind of indicator that we have for that is wage growth in 2022 was above mid-single digits. I think in the UK it was 6-7%. You fast forward to today, while it is still relatively tight, it's like closer to 3-4%. So nowhere where we were in 2022. But I think more importantly in how we view it is always look at the demand. Demand across global economies are very, very strong, particularly the US. And that's a combination of healthy capex. And I think more importantly, and this kind of talks about the longer term inflation and why you're seeing inflation being above target for many years now, is fiscal dominance. Governments continue to spend. US deficit is still elevated. UK as well. Across the world, demand is being subsidized by governments. And as long as that remains the case, inflation will be higher. But we still see economic growth being supported in that case, and that will be still a support for equities.
Coming up later on Asset Allocator, we'll explore credit markets and the new wave of IPOs. Join us after this quick message.
Opportunity is everywhere. Access is everything. Access is expertise, guiding you with local insight. Access is discipline within a diversified approach, from traditional asset classes to ETFs and alternatives. Access is connection across a global footprint. Because when the world of opportunity is truly in reach, access is everything.
Welcome back to Asset Allocator. So Jason, we've seen a fair bit of talk around US dollar weakness, but what impact does that have on UK-based IFAs and their clients?
Yeah, that's a great question, and I think people sometimes underplay the importance of currency, your currency views, and how currencies evolve, and that's the impact on client portfolios. Currencies are absolutely crucial for asset allocation. I think where it's particularly stark is your equities. So if you look over the long term, when you've had dollar weakness, it tends to be non-US regions that outperform. We've seen bits and starts of it at the moment as the dollar's weakened from late 2024. So US has done well. EU's done well. Emerging markets have done well. So you're starting to see that. But if the dollar weakness becomes a lot more structural trend, I think you'll start to see the performance of non-US assets outweigh those of US assets through the fullness of time. So I think that's extremely crucial. Secondly, how we think about currency and fixed income, there's quite emphatic evidence that what you want to do as an asset allocator for your fixed income exposure in particular is hedge that. Kind of no matter whether you think the dollar is strengthening or it's weakening. And the reason why are the reasons for that? So if you think about bonds, now they're giving you kind of mid-single digit yields. And if you're too exposed to currencies, so say for instance you're a GBP investor and you have US bonds, currencies can very easily move more than mid-single digits. So you could have, for instance, you have a US bond and the dollar weakens by 5-6%. That will kind of wipe out any of your income that you would receive from US Treasuries. So our view is, what you want from bonds is a reliable diversifier. If you have a deflationary recession environment, something that's going to appreciate in capital terms, and so you want to see that. And the best way to kind of secure that is to hedge out your currency risk. So our kind of philosophy for how we manage clients' portfolios is their home currency. We hedge back to their home currency, their fixed income exposure. So I think that's crucial to say. Now, what is our view of the dollar longer term? I think it's one of weakening. And there's kind of two crucial aspects to why we think that's the case. I think the number one by far is dollar valuation. I mean, you kind of have to go back to the late 90s to see the dollar as overvalued is as the moment. And, kind of the rules in asset markets is valuations is the gravity. So, you can kind of, if you kind of think of an elastic band and valuations as kind of your stabilizer, you can stretch it, but it always kind of comes back to, to that stable point, and that your valuation is your stabilizer. So, we think that the dollar is overextended in terms of valuations. I think that over the long term, that kind of migrates downwards. And I think secondly, this kind of talks to the inflation piece as well. What you're seeing with a lot of geopolitical shocks, the supply shocks you're seeing, is what that means is nations start having to start thinking about investing domestically to offset any of those kind of supply shocks that they have. And I think using the Iran-US conflict as a case study, it kind of show what I'm thinking about is, what you've seen over the last 20, 30 years is a lot of, these current account surplus countries, invest in US treasuries, invest in US equities, just because they had like this excess capital. But what's happening now is they have to invest domestically. So, you're starting to see it with the UAE. They're fast-tracking this pipeline to bypass the Straits of Hormuz. That's money that would have ordinarily been parked in US treasuries, been parked in US equities. Now it has to be invested at home. You look at Europe, Germany was a massive current account surplus country. It now has to invest domestically, both in terms of defense and infrastructure, and to stimulate domestic demand. So that money that would have gone to US dollars is now being invested internally. So I think that's another headwind. It flows to the dollar. And I think a short-term signal that we've seen that maybe suggests that this dollar weakness is a lot more structural is what typically happens is when you have these massive risk-off events, the dollar tends to strengthen quite significantly. And I think it's quite telling what you've seen in April 2025 during the tariff tantrum, and then now during the Iran-US conflict, the peak of the risk-off. The dollar strengthened, but nowhere near the degree to what you've found historically. It was actually relatively middling. And so that's just the signs that the dollar is overextended on a long-term basis. And so our expectation is over the medium term, the dollar weakens. And, what kind of assets do you want in that environment? Of course, I mentioned non-US equities, but more specifically, EM assets do fantastically well in that environment, which is why not only overweight EM from a equity region standpoint, but also have some emerging market debt. And commodities as well. Commodities love a dollar weakening environment. And it's kind of no coincidence, since 2022, 2021, commodities have had a good run. Obviously, you've had the supply issue, but I think the dollar starting to weaken is also propelling commodities to new highs.
In the world that you're describing, where maybe the dollar is less weakened cyclically, but also is perhaps less structurally relevant, what replaces it? Does some one thing replace it, or is there just a wider dispersion?
So I think there's kind of two things to think about. I think firstly, from a reserve currency standpoint, I think that's a longer term picture. I think the dollar will remain the reserve currency because so much of trade is domiciled in dollars. It's still the way the US is still by far the strongest economy, one of the biggest economies as well, if not the biggest, depending on how you measure it. But having said that, and we are starting to see growing signs of trade being domiciled in the Chinese currency. I think gold is, of course, the topic du jour. Central banks, particularly EM central banks, are starting to increase their allocation to gold. So I think that's just going to become a greater theme across the long term.
So, Jason, the last time you were on the podcast, you discussed tight credit spreads. Fast forward today, what do you make of where we are now?
Yeah, so I mean, credit spreads are extremely, extremely tight. I think the question we have to ask is, firstly, does that make sense? And I think it actually does make sense. So, what is credit spreads a proxy for? It's a proxy for risk on. And so is it no coincidence that, as equity markets are close to all-time highs, growth is relatively resilient, corporate balance sheets are relatively underlevered, that you'd see credit spreads at all-time highs? No surprise there. Do I think it tightens much from here? I don't think so. And that's just, just the mathematics of it. And so I think when you think about your asset allocation now, if you have an asset class which can't go up that much more because credit spreads are so tight, is it the best risk return that you have from asset allocators' perspective? And I don't think so. So, you probably have better risk reward in equities because, at least equities, your upside is relatively uncapped. And I don't think it's enough of a defender of capital as well. So I'd rather prefer government bonds where, because, let's say, for instance, you get into a deflationary recession, what will happen in that case is bond yields decrease. So you get that capital uplift from government bonds. But then what happens with credit is your credit spreads would probably blow. And so it would offset anything you get from the bond yields. And so as a complex, we relatively negative on credit just from those dynamics. Now that doesn't mean there's not idiosyncratic opportunities within credit that we don't that we wouldn't like. In fact, most of our fixed income, our corporate credit exposure is in these idiosyncratic opportunities, such as emerging market debt. We also got a healthy allocation to catastrophe bonds as well, which we see the return profile relatively divorced from the global macro. It's got its own idiosyncratic drivers, healthy credit spread there, and returns just look relatively good. So I think credit is very much an environment for stock picking there.
In the credit universe, do you see more of those idiosyncratic opportunities at the investment grade level relative to the high yield bond part of the market, or the other way around?
I think it's probably more on the high yield side of things. So that's where kind of the bulk of our exposure is. We think investment grade is there just isn't enough kind of spread on offer to kind of give you your healthy returns where at least with these higher yield opportunities. And also I think the way I think about it as well, while it's classified as high yield, there's certain structures within these credit opportunities that actually make the risk a lot lower. So, for example, catastrophe bonds, while maybe people view it as a high yield instrument, I'd argue its drivers are a lot lower risk than first perceived. Even CLOs as well. CLOs, the credit protections that you get are a lot more enhanced than I think what's traditionally viewed. And look, emerging market debt has its kind of own drivers. So that's where we're seeing the opportunity. You're getting yields, between 7 to 10%. You compare that to investment grade corporate debt, which is kind of closer to 4 or 5%. In that kind of category, we prefer government bonds.
So, Jason, equity markets have remained incredibly resilient. My question to you is really, how long can that last for? And how do you think about diversification within equities?
Yeah, so, kind of $1 million question, given where markets are at. So I think the first thing to say is, how we view equity markets is always back to the macro fundamentals. And, if you look at the last quarter in the US, I mean, earnings growth was absolutely spectacular. I think it was kind of well above 20%, which you'd have to kind of go back to 2021 to see a similar earnings growth. And so you've got that fundamental support. And the earnings growth at the moment for US equities in particular is not only helped by the strong macro that I've talked about, but of course AI as well, which is the theme at the moment, and that's helping spur the market on. And what I like about it is over the long term, what drives share prices? It's earnings growth. And I think what's relatively comforting, look, and notwithstanding share prices in the AI space, kind of going mental, is at least it's been backed up by earnings. So if you look at Nvidia, its share price obviously done well over the last few years, but you plot that against earnings growth, and it's not a dissimilar picture. So what gives us comfort if you've got that support, while valuations on historic context are elevated for equities. I don't think it's too detached from reality. I think earnings growth can still support you. Where it does become a lot more challenging is, let's say, for instance, you get the S&P 500, above 30. Then I think that elastic band that we chatted about, that gravity starts becoming a lot stronger. But I don't think we're there yet. And I think there's still the demand drivers within the global economy to support earnings growth. Capital investment is a massive theme, not only within AI, defense, infrastructure as well. So that's helping earnings growth across the complex. Now, you talked about diversification. Of course, a lot of the equity market at the moment is driven by AI stocks, highly concentrated in that. And so one has to be careful when constructing a portfolio that you're not overly reliant on one theme, one beta. Because AI is now driving emerging markets, for instance, particularly emerging markets ex-China. So you have to be very cognizant of the exposures that you are taking on board. And that's why I think you've got to kind of look at two things. A, where the value is. So, one of the places where relative value is Europe, where we think, firstly, you potentially got demand drivers through German fiscal stimulus. It's looking like from the earnings forecast that European earnings in the next year or two will be relatively healthy. So that gives you a support there. And as well, if you look at the relative valuations of Europe, I think it's a discount of 30% relative to the US versus historic average of 20%. And then you also want to diversify yourself in terms of factors and themes. So, obviously growth and momentum is a strong factor. Have a healthy allocation to value. That can be within the UK, which tends to be a strong value market, but there are other pockets as well. And then themes. I talked about CapEx not only being a AR adjacent theme, but defense. And then, so if you think about it, capital investment, who's going to be one of the beneficiary of that is banks. They have to help finance these massive capital projects that are going on at the moment. So that's also, potential sector that could do well. So, I think it's being diversified across region, factor, and thematic.
One of the challenges with equity market diversification, and you did sort of touch on it, is, historically, if the S&P is hitting an all-time high or Nasdaq's hitting an all-time high, you go, well, what's the opposite of that? And the opposite of the US is the emerging markets, historically. But right now, that seems to be less the case because the AI theme is so strong there. And in fact, we've seen that in the last few days, where the market got a bit jittery about AI in the US, and there was a bit of a sell-off, but the Korean market also sold off spectacularly, and that's a market that is very focused on a small number of AI stocks as well. So you touched on regional, but how does that quest for regional diversification intersect with the sector exposures within regions?
I think that's, again, where asset allocators have to kind of earn their money. So you have to kind of be a little bit more conscious of those exposures, exactly you talked about. So it's no longer just saying, okay, my EM is, I've got this allocation there and I'm just totally diversified now. Think about exactly what you talked about. And so, one of the ways you can mitigate that is, you could look at, ETFs or even active managers who may be playing that theme a little less to give you that diversification. So if you want to pay, you just want to play like kind of dollar weakness or commodities going up, look for regions within EM that are a little bit more attuned to that. So it could be Latin America, South Africa, other EM countries. You could also have active managers who are not playing that theme as aggressively, who may be underweight the AI complex. So I think that's the one way I think about it. And I think a region like Europe doesn't, whilst ASML is the strongest, the biggest company in Europe at the moment, all else equals, Europe tends to be a little less kind of AI adjacent. And so I think that region, you can be relatively comfortable that if AI had to pop, it could be relatively protected. But then also, going to the biggest market, the US, again, I think it's just being extremely diligent about your exposures. So, whilst S&P 500 is up, I think, 10% year to date, if you take away all the AI companies, I think it's barely flat. And so I think there's just a raft of subsectors within the US that you can invest in, or sub-styles as well. So I talked about banks. Banks could be a potential exposure in the US you want to have. Even value adjacent managers as well. So I think one just has to be extremely diligent.
There are some really big name IPOs at the moment, and AI is obviously dominating much of the conversation. What I wanted to ask you is, how's that shaping your thinking at a portfolio level?
Yeah, it's IPOs, I think, can be extremely kind of divisive from like a market commentators, asset allocators lens. It's just because you have some who just say, okay, these mega IPOs are coming in, that's signaling top of the market. No one lists at the bottom of the market. But then you get others that say, yeah, this is just a healthy environment for the market. You're starting to see IPOs come back in, and maybe just just gives evidence that the bull market has legs. Now, kind of from the data, from the evidence, it's less kind of conclusive either way. The one thing I will say is, while people see these mega IPOs and think, oh, there's just so much, there's an avalanche of money coming in, flooding the market. One has to realize that the US market cap, the total market cap of US markets is $77 trillion. And so, you think about, even with SpaceX, 1.5 trillion, Anthropic 1 trillion, OpenAI probably not too far away from that. While these are massive companies, the broader context is a lot bigger. So that's the first thing I'll say. Secondly, if you actually look at equity supply, it's a lot lower than what people think. So, what you've had is a lot of buybacks, particularly last quarter. So JP Morgan did some analysis. I think their estimate for equity supply for the year is about 200 billion. And again, 200 billion in the context of 77 trillion, it's a drop.
Yeah.
And then secondly, if you look at number of IPOs, so at the peak in 99, you had 400 IPOs. And, today, I think Goldman Sachs estimate is about 100. So again, it's elevated, but it's not, it's nothing what we've seen before. And then even with the equity supply, so I mentioned the 200 billion. In 2021, you had 600 billion. So even compared to recent history, what we're seeing is, I wouldn't say nearly a deluge. And then secondly, in terms of performance, again, Goldman Sachs estimate is looking at the 4 largest IPOs kind of per cycle over the last 40 years. Again, relatively inconclusive. You've seen the month leading up to these IPOs, S&P fall roughly like 1%, but then in the subsequent month, it's up 5%. The most important thing you have to look at is just the fundamentals and the macro fundamentals. If the macro is relatively resilient, economy is still growing, it will overlook anything from the IPO. So that's the most important thing. Then kind of.
Is there a risk? Do you think that that allocators, that investors, whether even retail investors, sell some of their existing AI listed holdings, just top slice them to buy into the IPOs, and therefore that has an impact on the rest of the AI stocks, or the big 7 stocks or whatever?
Look, I think it could be an impact. I think I kind of still mentioned the 77 trillion. So I think it's still such a big number. And so if you look at these IPOs, while they're big from a market cap perspective, the actual free float at the moment is relatively limited. So while people might sell to fund some of these to participate in these IPOs, I think the pool is just too small at the moment to have a massive impact on these other stocks. I mean, if you look at Micron, for instance, it's $1 trillion, which is going to be fairly similar to what Anthropic is, and then you've got SK Hynix as well. So I think markets just have moved so much that and the numbers involved are so high that I don't think these IPOs will suck as much capital than maybe they would have, a couple of years ago. So I think it shouldn't be too bad. Look, I think where the caution comes in is a little bit more on the sentiment side. And so, is this just one element where you're on a road of things just becoming, just over exuberant? And maybe we are in that journey, but maybe from a fundamental kind of demand supply balance at the moment, I'm not too concerned.
This is such an interesting topic. I'm sure we could talk about this for such a long time, but sadly, that's all we have time for. So thank you very much for coming in, Jason and David.
Thank you, Jason.
Thank you so much.
And thank you to our audience for tuning in. Be sure to come back next week for the Asset Allocator podcast in either video or audio format. You can also log onto our website, ftadvisor.com/asset-allocator. Until the next time, goodbye.